not only for your benefit, but for the other two. Begin with multiple choice problems. So, aside from giving you the solutions to the problems, I mean the letter answers, I will involve the solutions. So at least maybe hopefully we can finish all. Now, can you hear me? Everybody, can you hear me?
Yes, ma'am.
Yes, ma'am.
Now you tell me, or by just raising your hand, you tell me if you cannot hear well. So at least I can adjust the laptop. Okay? So we go to requirement number 1 of the multiple choice problems in chapter 2. And the requirement is to calculate the amount of goodwill. You are given the account balances on June 30 and included receivables, inventory, buildings, equipment, and the total assets. Then we have your current liabilities, long-term liabilities, and the common stock, and the retained earnings of SS company. On June 30, PP paid 300,000 cash for all the outstanding stock of SS, which still continue to exist as a separate entity. In connection with the acquisition, PP paid 10,000 in indirect combination costs and agreed to pay 50,000 to the former owners of SS contingent on meeting certain revenues during 20X4. PP estimated the present value of its offer and probability adjusted expected payment for the contingency at 15,000. In determining its offer, PP noted the following pertaining to SS. It holds a building with a fair value 40,000 more than its book value. It has developed a customer list appraised at 22,000, although it's not recorded in its financial records. It has research and development activity in process with an appraised fair value of 30,000. However, the project has not yet reached technological feasibility, and the assets used in the activity have no alternative future use. Book values for the receivables, inventory, equipment, and liabilities approximate for uh, fair values. So calculate the amount of goodwill. Okay, now let's go to cash. Actually, the answer is letter C, and that is 33,000. We begin with the cash consideration transferred for 300,000. Then we add contingent performance obligation, 15,000. The total is the fair value of subsidiary for 315,000. We deduct the book value of SS company. That's equal to 90,000 and 100,000. So the total is 190,000. We deduct it from the fair value of 315,000. The difference is the allocated excess of 125,000. From the allocated excess, we deduct the over or undervaluation of assets and liabilities. Increase in building, 40,000. Increase in building, 40,000. By the way, we have 100% acquisition. So the increase in building will all go to the parent for 40,000. Increase in customer list, 22,000. Increase in research and development for 30,000. So the total now is 92,000. Deduct from 125,000, the difference is goodwill. So that's the requirement of the problem. If we have to trace the entries, though it's not required in the problem, we debit to number 1 and 3, debit investment in SS company, 315,000, credit to cash, 300,000, and credit estimated liability on contingent consideration for 15,000. Also, we debit to acquisition expense, which will be finally debited to retained earnings for 10,000 and credit to cash for 10,000. Okay, it's not required to prepare the journal entries, but I know this will help you in understanding the determination of the goodwill. So if you will be prepare an elimination entry on the date of acquisition, the elimination entry or the adjusting entry and the elimination entry will be to debit receivables 80,000, debit inventory for 70,000, we debit to buildings for 115,000 because you got an adjustment. So debit to buildings for 115,000. We debit to equipment 25,000. Debit to customer list 22,000. Debit capitalized R&D or research and development, capitalized R&D for 30,000 and debit to goodwill for 33,000. Then likewise, we credit to current liabilities 10,000, long-term liabilities 50,000, and credit back investment in SS company for the elimination entry. So that will be your entry if ever you are required, but we are not required here. Okay, now we use the following information for questions 2 and 3. We have now Platic purchasing 100% of Smith for 600,000. At that date, Smith's company had the following book and market values. So we have now cash and receivables inventory, plant assets, current liabilities, long-term debt, common stock, and retained earnings. What is the total purchase differential? What is the total purchase differential? Actually, you are not given any data to adjust, but only the difference between the book value and the market value. So in this case, we have the difference between the book value and the market value. If you try to determine the book value for the assets totaling 450,000. That's the total of the assets of Smith. So 450,000, and then we deduct the liabilities and the long-term debt. The total here is 450,000. However, with regards to net assets, the assets at book value, 450,000 minus 180,000. That gives us the difference of 270,000. However, if we try to determine the market value, no, the net assets, it now gives us the total market value is for 580,000. Is that correct? No, 680,000. 680,000. That's the total of the market value and the I mean the total assets for 680,000, and then we deduct 180,000. That gives us the difference, or the market value equal to um, 180 deducted from 680. So the market value is 500,000. Okay, now these are the only given data, and Smith is paying an amount of 600,000. So what will be your differential? We have now 600,000 minus 15,000, the common stock of Smith, and the retained earnings of 255. So we now deduct 600,000 minus 270,000. We have now the purchase differential of 330,000. That's the asindog. In other words, the amount of the consideration is 600,000, though the book value of the interest of Smith is only for 270,000. What is the amount of the worksheet elimination to plant assets on the acquisition date? So, what is the amount of the elimination, worksheet elimination to plant assets on the date of acquisition? So, we have 475,000 minus 300,000. We have now 175,000. So it's debit. So the answer to number 3 is letter C. Okay, we go to number 4 and 5. Numbers 4 and 5. Question number 4. The amount of differential associated with the acquisition. Now, what will be our answer for number 4? Okay, for number 4, the consideration transferred is given at here, the amount of the consideration, no, for 100% of Celtic Corporation. So we have given among the accounts of Enya is 150,000. So it appears that Enya here is the parent and Celtic is the acquired subsidiary. The investment account in Inya's books shows a balance of 150,000. In other words, this is the consideration transferred. Then from this, we are going to deduct the book value of the shareholders' equity of Celtic. So what is now the book value of the shareholders' equity of Celtic? In here, we are going to add the given book values for the common stock of Celtic, 40,000, and the retained earnings of 52,000. So we are now having 92,000 for the book value of the shareholders' equity of Celtic. Therefore, 150,000 minus 92,000, the allocated excess. That's the excess of the fair value over the book value is 58,000. And sometimes we call this differential. Just like in number 2, we call this purchase differential. So the answer to number 4 is letter D. The answer to number 5, the consolidated balance sheet of Enya and Celtic will reflect goodwill in the amount of. So how much is the goodwill for? Here, the amount of goodwill is the difference between the consideration transferred of 150,000, and then we are going to deduct the fair value of the assets of Celtic, 173,000. We deduct its accounts payable and bonds payable of 45,000. So what is now the difference? We deduct 173 minus 40, that's 133, minus 5 is 128. Deduct it from 150, so we have the difference of 22,000. The answer to number 5 is letter B. Okay, we now go to questions number 6 to 8. In January, Wilton Company acquired all of Cyrus for 365,000 cash. On that date, we have the balance sheet of the Cyrus Company. Cash, inventory, land, buildings, equipment, total assets of 380,000. Then we have the liabilities, the common stock of Cyrus at 1 peso par, the APIC, retained earnings, and the total of the equities. The fair value of all of Cyrus assets and liabilities were equal to their book values except for inventory that had a fair value of 85,000, land that had a fair value of 60,000, and buildings and equipment that had a fair value of 250,000. Buildings and equipment have a remaining useful life of 10 years with a zero salvage value. Wilton Company decided to employ push-down accounting for the acquisition. Subsequent to the combination, Cyrus continued to operate as a separate company. Now, what amount will be present in the revaluation capital account when eliminating entries are prepared in number 6? So, what amount will be left as part of the elimination entries? What will be the balance in the revaluation account? Okay, now we begin with the book value of the assets of Cyrus. The total is 480 book value, no? Ang assets ni Cyrus. We now begin with 80,000, 50,000, and 200,000. That makes a total of 330,000. We now deduct the inventory with a fair value of 85,000 and land 60,000 and buildings and equipment 250,000. So that's 395,000. So in number 6, our answer is D as in dog. That's number 6. In number 7, what amount of differential will arise in the consolidation process? Now, it's zero since the revaluation as computed in number 6, which is equal to 65,000, is already recorded in the books of the subsidiary, not in the worksheet or eliminating entries. So in other words, in number 7, the question is, what amount of differential will arise in the consolidation process? As stated, the fair values of all of Cyrus' assets and liabilities were equal to their book values, except for inventory that had a fair value of 85,000, land 60, and buildings 250. And they have remaining life of 10 years. And we have now your amount to be recognized here is zero since the revaluation of 65,000 is already recorded in the books of the subsidiary and not in the worksheet or eliminating entries. Now in number 8, the question is, the write-up of building and equipment will. Question number 8, the answer is boy. decrease Cyrus' reported net income for 20x4 by 5,000. 250,000 minus 200,000, that gives us 50,000 divided by 10 years. So we have 5,000, the depreciation to reduce net income of Cyrus. So that will be your added depreciation, good for 1 year. So we have now in number 8, letter B. Next, we go to number 9. Use the following information for questions 9 and 10. Pine Hollow acquired all of the outstanding stock of Stone Briar by issuing 100,000 shares of its 1 peso par value stock. The shares have a fair value of 15 per share. Pine Hollow also paid 25,000 in direct acquisition cost. Prior to the transaction, the companies have the following balance sheets. So we have now in uh, the balance sheets of the parent and the acquired company. So what are now the balances? In the parent, we have assets, then liabilities, current and long-term, and then common stock, peak and retained earnings. The same in the books of the acquired company. So we have now the book values of the balances of the accounts in the books of the two companies. The fair values of Stone Briar's inventory and plant, property, and equipment are 700,000 and 1 million respectively. So inventory, instead of 600,000, it's 700,000, and the property, plant, and equipment here, instead of 900,000, it's 1 million. The journal entry to record the purchase of Stone Briar would include in number 9, the answer is C, debit to investment for 1.5 million. Now, why do we use 1.5 million? Okay, so that's now 4. Pine Hollow also paid 25. So 100,000 shares at par of 1 peso. However, the shares now have par value of 15. So we multiply 15 by 100,000. That's the consideration transferred. So in number 9, the answer is C, debit to investment for the consideration transferred. And the goodwill in relation to the purchase in number 10. Again, we compute goodwill equal to, okay, goodwill is computed by deducting from the consideration transferred of 1.5 million, then we deduct 1.9 million minus 100,000 minus 600,000. We add the increase of 100,000 to inventory and 100,000 to property, plant, and equipment. So the difference is 100,000. That's the amount of goodwill. So again, 1.9 million, the assets of Stone Briar minus its liabilities of 100,000 and 600,000. So that leaves 1,200,000. 1,200,000 plus 100,000 plus 100,000, giving us a total of 1,400,000. The book value, fair value of the interest acquired. So we have now 1.5 million minus 1.4 million. The answer is letter A. And that's in number 11. I mean in number 10. Number 10, the goodwill is 100,000. Next numbers, we have 11 to 14. 11 to 14. Here, add-on company acquired Venus Corporation, full acquisition for 300,000. The balance sheet of Venus prior to the acquisition. Total assets 430,000. Liabilities and totals 215,000, and the balance is for the shareholders' equity of Venus. At the date of business combination, Venus net assets and liabilities approximated fair value except for inventory which had a fair value of 60,000. So instead of 75,000. Land with a fair value of 125,000 instead of 100,000, and buildings and equipment at net with a fair value of 250,000. So, if you compare the fair value and the book value for inventory, the fair value is lower than the book value. For land, the fair value is 125,000, higher than the book value, and buildings and equipment also higher. What amount of inventory will be included in the consolidated balance sheet immediately following the acquisition? So the inventory balance, we are now in number 11. We have to recognize it at fair value. So letter C. What amount of goodwill will be included in the consolidated balance sheet immediately after the acquisition? Okay, so let's compute for the amount of goodwill. The consideration transferred as given in the data, the consideration is 300,000. Okay. Then from the consideration transferred, we are going
Excuse, ma'am.
to
Ma'am,
deduct ano
excuse, ma'am. Basi ma-end, bala mamang imo, ma'am, nga
home.
recording, ma'am. Kay ang remaining meeting time, ma'am, gagawa, ma'am, 3 minutes, ma'am.
Ate, kung mag-end ng recording, anong matabo? Kung ma-end kita, kay ma-end ang Zoom, ti anong matabo? Madula? Kay gin-record naman nimo? Ga recording man ko? Ti mautod, dason
Ma-save na na, ma'am.
ano?
Start kalaliwat, ma'am.
O, ma-start ko liwat.
Mas-save man na Japon, ma'am.
Oo,
Sige, ma'am.
ma-save man na
Thank you, ma'am.
gyapon kung magkuan, kundi ma-end ang Zoom, di for recording, magliwat for recording man gyapon. Ma-continue man. Oh, let me finish number 12. So number 12, 300,000 minus 35,000, no? Open parenthesis. 35,000, 60,000, 125,000, and 250,000, no? So bali ang minus, open parenthesis. 35, 60, 125, 250, and minus 65,000 and 150,000. So that gives us the amount of goodwill equal to letter C for number 12. Okay? That's the amount of goodwill equal to 45,000, and the answer is letter C. Now for number 13. For number 13, the answer is D as in dog. That's 85,000. So consideration transferred 300,000. Less the book value of the shareholders' equity 100,000 and 115,000, 215,000. So the allocated excess is 85,000. And that's called the differential. Now, that's in number 13. The answer is D. In number 14, the answer is letter A. Investment in subsidiary. in the consolidated statements is already eliminated. So that in number 14, your answer is 0. And 0 is letter A. Okay? So that ends number 14. So meaning with 15 up to 19, we are going to begin with the next timing of Zoom. Okay, the time now is 10:15. So we will open 10:15, mga 10:55 siguro. 10:15 up to 10:55. Amo naman na ang aton nga